Welcome to your weekend view, where we bring you the latest insights and trends in real estate investing. I'm your host, Daniel Brereton. In finance, time is quite literally money. A dollar today is worth more than a dollar tomorrow. This fundamental principle, the time value of money, underpins every investment decision that we make. But what makes this principle particularly relevant now is how dramatically the discount rate, that rate that we use to value future cash flows, has shifted in this uncertain economic landscape. Interest rates fluctuate, and when interest rates do fluctuate, the entire investment universe reshuffles and recalibrates. Right now, we're witnessing a delicate balance between yield curve normalization and growing stagflation concerns. After an extended inversion period that ran from October of 22 to December of 24, the yield curve has been gradually returning to its normal upward slope. This traditional pattern might suggest economic stability, but the real situation is a bit more complex. Aside from politics, the Fed finds itself in an increasingly delicate position, very difficult position. Rising stagflation risks, where high inflation persists, but there's also rising unemployment. It creates a challenging policy dilemma. Normally, the Fed would raise rates to combat inflation, bringing the inflation level down, but also cut them to address unemployment and stimulate the economy. And you really can't have both. For real estate investors, particularly those focused on income producing assets, understanding these dynamics is crucial. In an environment where discount rates are elevated but potentially volatile, income stability becomes paramount. Fixed income investments, like real estate backed private lending, offer predictable cash flows, but their returns, typically being lower than equity, reflect this certainty. And equity investments, where you're a part owner in a real estate property, sit further along the risk spectrum, offering potentially higher returns precisely because the outcomes aren't guaranteed. At Equity Multiple, we structure investments across this risk-return spectrum. Senior debt positions provide regular income, with the security of being first in the payment priority. Preferred equity sits somewhere in the middle between equity and debt, and balances yield with moderate risk. And common equity offers the highest potential return, but greater uncertainty and a longer investment horizon. We've recently launched several income-oriented investments on the platform. These senior mortgages are backed by commercial real estate properties and have attractive monthly yield and relatively low loan-to-value ratios, offering downside protection, especially given the low cost basis that we're able to get in this current market. You can learn more about our current offerings by visiting equitymultiple.com or reaching out to my team by sending an email to ir@equitymultiple.com. Thanks for tuning in. Stay disciplined, stay diversified, stay informed, and we'll see you next week.